A few days ago, Michael Burry tweeted a scary stock market prediction. It's scary and deep because it's predicting that the market crash is going to get a whole lot worse. And the stock market crash is going to get much worse because the Fed is going to stop trying to fight inflation and let it run wild. So Michael Burry's prediction is that the 2022 stock market crash is only just getting started and is going to be one of the biggest we've ever seen. But the best bit is that most people didn't understand the tweet and took it to mean the exact opposite. So let me go through what Michael Burry said, analyze the data, and talk about what the theory here is. It's actually really interesting and it goes really deep. So in this tweet, Michael Burry says this supply glut at retail is the bullwhip effect. Google it. Worth understanding for your investing endeavors. Deflationary pulses from this will lead to disinflation in CPI later this year, which will mean the Fed reverses itself on rates and QT cycles. Let's unpack this because this is a really important point. I am generally not a big fan of Michael Burry. He is very famous for predicting the financial crash back in 2008, although his prediction came way too early. But the thing with Michael Burry is that he is always promoting and advocating the next big market crash that will be the worst ever. Here he is in 2015 saying there are terrific stresses in the economy, which means it is definitely about to crash. And in 2017 saying the stock market is about to have a complete meltdown and World War III is about to erupt, and in 2019 the biggest ever market crash is right on the doorstep and will take the market all the way down. Except the stock market just kept on going up, and we have had one of the biggest ever bull runs in the history of the stock market. The thing with predicting stock market crashes is that if you shout wolf enough times, eventually you are going to be right, because stock market crashes do happen from time to time. There is a cycle. A broken clock does happen to be absolutely bang on right twice a day. And he has recently upped the ante with his catastrophic predictions on Twitter, saying that as interest rates rise, stock market valuations are going to collapse. But this tweet goes a whole lot deeper. First, he talks about the bullwhip effect causing the supply chain issues we are seeing, and he is right. The bullwhip effect in economics is the amplification and distortion of the natural supply and demand trends that can lead to massive unforeseen market effects. In the right circumstances, it can take the natural swings up and down in the supply chain and make them into a complete disaster. It works a little bit like this. Think about a dealer that sells cars. Let's say that dealer sells 100 cars a month. The pandemic hits, the showrooms are shut, everyone is panicking, so nobody wants to go and buy a car, so the dealer has a think about it and massively reduces his orders from the car manufacturer for the next few months. They slash their orders down to just 40 cars a month. And a couple of months later, at a board meeting of the car manufacturer, they see that their orders have been completely slashed. They have built up some inventory over the last couple of months, so they expect the downward trend to continue, and they decide that they don't want to produce cars that nobody's going to buy, so they drop their production from 100% to just 30% as a result. And because of that, they immediately go and reduce their orders for parts with their suppliers down to 30% as well. A month or two later, the board of the parts supplier company sees that their orders from the car company are collapsing fast and are now down from 100 to just 30%. And as they've been dropping, they've been building up their inventory of parts, and they are scared that they're building all these parts that nobody will use and they're going to cost the company a lot of money. So they go and stop producing their parts and they reduce it all the way down to 20% of their normal production rate. So the parts company reduces their orders from the raw materials and metals mining companies down to 20% as well. And then a month later, the board of the metal mining company goes and meets and sees that their orders are 80% down, and they have also built a giant stockpile, so they order production down by 85% to only 15% of their capacity. So you can see how psychology and corporate strategy and the timing of these things can amplify this sort of problem quite drastically. Demand drops down by 60% all the way down 40%, but the problem then amplifies all the way down, and the mining company is now operating at just 15% of their normal capacity. And then the demand picks back up, and that gets the exact opposite effect happening, but it's even worse now. That's the bullwhip effect in action. The car dealership suddenly sees a flood of new buyers turning up who postponed their car purchases because of the pandemic, and the demand goes to above the norm, to 140% of what the normal demand is. The car dealer wants to make sure that they fulfill on the high demand, and they place orders for 150% of the norm with the car manufacturer. The car manufacturer sees a massive spike in demand for cars that is now 150% of the norm and says, hey, I don't want want to run out. I don't want to not supply enough while this demand is happening. So they order 160% of the normal rate of car parts from the other company. The parts manufacturer goes and orders 180% of their usual metals order and makes sure that they have a buffer. And at the end of the chain, you have the mining company boss. And he's just laid off a bunch of people, shuttered some of his mines, got into financial trouble because of the massive reduction in capacity, and he was running at 15% of normal production. And now the orders turn up and he has to increase production from 15% all the way up to 180%. And he can't do that overnight. He doesn't only have to go back to full capacity, which is hard enough, but he has to increase production beyond that, hire even more staff and expand the mining operation. All of this is going to take time. The parts manufacturer has to build new factories themselves to cope with the increased demand. And so the prices of the raw materials skyrocket because there's just not enough supply in the supply chain. The parts manufacturer has to increase their prices even more to allow for their own cost and to have some kind of a risk buffer, just in case the metal price goes even higher. The car company then has to raise their prices even higher still than the parts manufacturer, and then the dealer goes and sticks their markup on top. And you can see the problem here. The bigger the initial impulse to the bullwhip, the bigger the wave that you're going to get at the end. And when you have a major, once-in-a-lifetime kind of event like COVID turning up and the financial response to COVID by the governments around the world, the bullwhip effect from these is going to be pretty big. That is the theory. And here is where the point Michael Burry is making gets really interesting. As the prices go up, inflation naturally skyrockets, and we're kind of seeing some of this happening right now, and demand for high-priced products drops. In some industries, that can cause a very big deflationary pulse because the sharp decline in demand can coincide with the massive ramp-up in supply because the production has been ramping up, new factories coming online, all of that kind of stuff. And this can have a very noticeable effect as inflation may stall or even drop significantly as a result. And then the public opinion will go back to inflation being transitory. It was successfully defeated. It went away all by itself for the first time in history. And the Fed will immediately declare a victory. There'll be praise from every single media outlet for stopping inflation without having to increase rates very much. Maybe even reduce the rates back to zero. Go and stimulate the economy now that inflation is gone. And while all this is happening, the next down wave of the bullwhip would be coming because the dealer will reduce their orders to the car company by even more than the last time. The car company will contract even more still, and so on down the chain. And then when the next wave arrives, everyone will be massively surprised when inflation suddenly goes back up and goes back up a heck of a lot faster and a heck of a lot higher than anyone expected. And while the Fed is toasting their success, we may be staring at the biggest ever inflation spike in modern history. It's certainly a really interesting theory, and it does have a lot going for it. A few days earlier, Michael Burry tweeted, "Question. In 2022, what brings a Christmas in July? Answer, a disinflationary, overstocked consumer recession at Christmas." And if Michael Burry is right, the stock market crash that we have seen so far in 2022 will look like peanuts compared to what is yet to come. It is definitely possible, but the global economy is a very complicated beast and there are so many different factors to consider. One of the arguments that Michael Burry uses a lot is the fact that the stock market is overvalued when you consider the Shiller PE ratio. This is the ratio that many people refer to of earnings of companies over the last 10 years to their current valuations. The popular theory is that the average of this ratio is somewhere around 16 or 17. And right now, we're at 29.5. So even after the market dropped so far, some economists, including Michael Burry, will say that the market is still massively overvalued. And there are several obvious problems with the logic of this argument, though. In the time of fast technology advances, you would naturally expect this ratio to be higher, because you have many newer companies that haven't been around a long time or were much smaller 10 years ago, and their current valuation bears very little relevance to how much profit they made 10 years ago. Many of today's biggest companies like Amazon or Tesla are in a completely different place to 10 years ago. In fact, the markets can actually stay flat and the valuations cannot go anywhere at all. And if those companies' earnings remain at just the same level or grow ever so slightly, then the Shiller PE ratio can drop down significantly without any market market crash happening. Because for the PE ratio to drop, one of two things can happen. You can either have a drop in prices, which is what happens in a market crash, and everyone says that is the only way that the Schiller PE ratio can drop, but it can also drop if you have an increase in those average earnings. And most people citing this chart as evidence that a crash is absolutely, definitely imminent tend to miss that point out. And an even bigger question is, why does the Schiller PE ratio have to be a flat line? What is the logical reason for that? That the way that the companies were valued back in the 1880s, 1890s, early 1900s has to be exactly the same as how they are valued today. People's life expectancy is in a completely different place. People's access to money and investing timeframes, the way that the whole financial system works and the maturity of it is a completely different place. People's retirement age today is older than you would be expected to die back then. If somebody gave you this chart and a crayon and told you to draw a best fit curve through this data as you see it, based on the data alone and not based on your guesswork, would you draw a straight line through it? Or could it possibly be that the relationship is not a flat line? If you remember that in the late 70s and the early 80s there was a huge one-off inflationary spike, and you go and say take that massive outlier out of the equation, does it still look like a flat line to you? The truth is, it is very possible that Michael Burry is right, and the market crash is going to get a whole lot worse. It has happened before, it will happen again. But it is also very possible that we're going to be looking back at this prediction along with every other one that Michael Burry has made in the last 10 years that turned out to be a complete dud. If you are an investor and concerned whether your stocks might crash all the way to zero in this market crash, make sure you watch this video right here where I talk about which companies might get hit particularly hard in a recession. Thank you so much for watching, and as always, I'll see you guys later.